All right. I believe we are live. This is the Investing Power Hour number 82. My name is Brett Schafer. I'm joined as always by Ryan Henderson. We're 5 minutes early, 9:25 Pacific Coast time, right around 12:30 East Coast time, or 9:30 Pacific Coast time, like we always do. But we're going to go for an hour. We're going to talk about anything in the investing world. This is the easy time of the year. We got a lot of earnings to cover. Tons of topics. I'm sure we could go for even longer if we wanted. If you want to join and ask questions, we do, again, live every week at the time I just mentioned, 9:30 Pacific, give or take. Ryan, how are we doing? What are your feelings on earnings season so far?
I have lukewarm feelings. Actually, maybe luke cold, if that's a thing. There's been some bad reports. Well, honestly, some of the reports I thought were pretty good, but the market just kind of has shrugged off a lot of them. Google's, I don't think Google's was that bad. Like, that's probably the one that comes to mind first. What are some of the other ones? Meta's was solid. Microsoft was solid. I don't know. Amazon's going to report today. My thought is everyone wants a recession that isn't happening. It's kind of what it feels like.
Yet it's on the horizon, Ryan. Next quarter. Don't worry. Next quarter.
I know everyone's so worried. Like some of the prices that I'm seeing today on a lot of these stocks, and I know this is like everyone's going to say this about stocks in their portfolio. It seemed like you're going to get really good returns over 5 years. You just got to be willing to wait.
Yeah.
Maybe I'm just anchoring to like old prices, but also you can just like, I don't know. If you forecast any reasonable level of earnings, or if it's anywhere near what, for some of these companies, if it's anywhere near what they've earned over the last 5 years, it's going to be a good investment. But it just seems like everyone's worried that doomsday is here and the scary Jay Powell is going to raise rates again.
Yeah. It's a recession will show up eventually, but there's so many people I follow that have been saying this since 2021. Oh, next quarter it's going to turn over. Oh, this can't last forever. Oh, blah, 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 blah. Eventually it will, but hey, you've been wrong. And if you say that the recession's imminent every quarter, you will be right eventually. But I don't think it's really the best way to look at things. And we got a question here from Tyler. Thoughts on GDP growth and the general market's reaction to it? I don't know if the market reacts to the GDP growth numbers, but I don't particularly care about GDP growth. Yeah.
Is that going to help Philip Morris sell more cigs? That's what we're worried about.
I mean, it's a number, and there's a lot of numbers that go into that number, and there's a lot of estimates that go into that number. I don't particularly care. Here's what I care more about: payment volumes at Visa, MasterCard, and lesser extent American Express. And then banks stuff.
Let me do a little show for you here. Visa CEO comment from the conference call said, "We're not economic forecasters, and so at a macro level, we are assuming no recession. We are also not factoring in any impacts from rising inflation and student loan repayments because, as I mentioned before, we have yet to see any meaningful impact." Who's got a better purview on the consumer than the Visa CEO? I can't really think of many people. So Visa CEO said it. We're good. We're in the clear. Recession's over.
Yeah. No. I should be clear. Not when we say this, it doesn't mean we're like, oh, the recession's never going to hit. It's not here yet. It will be here eventually. I don't particularly care though, especially if you have a long time horizon. Also have a question or comment here from John. Says, good morning. Good morning, John. Says your guys' second largest position is in SGOV. Curious if you laddered into this or if it was just one giant purchase. That's just a cash equivalent. That's just a short-term treasury ETF. It's an easy way, very low fees to just get access to short-term treasuries without having to do any of the treasury direct stuff or whatever you got to do.
Yeah,
So,
it's not.
there's no thesis there. It's just you get 5.5% on a cash equivalent.
It's also, I think sometimes we post our holdings and it's just a timing thing. So I'll just go full disclosure. We sold Sprouts recently. I think it was probably a month ago now. We sold Sprouts Farmers Market, and we had that had grown into a bigger position, and we just had a bunch of cash. We hadn't picked anywhere to redeploy it, so we're going to just earn a little interest in the meantime on our cash balance, which we just think of SGOV as a cash balance. So it's not us saying, like, there's no real thesis behind picking SGOV. It's not like we think, oh, it's going to be a better return than all the other holdings. It's in the meantime, we're picking where to redeploy it. So it's more of a timing thing than anything else.
Yeah. We got a comment here from Fuhat, says a lot of small businesses going to go bust in the next couple quarters. That really isn't accounted for. I would disagree with that and say it's irrelevant. If we're looking at a broader economy, thousands of small businesses go bankrupt, I'm guessing, every quarter. So
yeah,
that's probably
this
what
quarter over others.
Yeah, they always are going to go bankrupt. COVID was a little bit of a temporary pause just because they said, all right, no one's going to go bankrupt. But yeah, there's always a reason.
There's always a reason to be bearish.
Yeah.
And it generally, most of the time, it pays to be bullish.
Yeah, well,
over the long run.
Yeah, as long as you don't take that too far. Don't take a good idea too far. All right, another comment here. We'll get into earnings. I want to hit maybe a couple of these. We can't just hit everything for the comments. Thank you for, I guess, the people that join. It's kind of fun. But comment from Tyler. I think this is also underappreciated. Lots of operating leverage in big tech. Google, Microsoft revenue growth 12 to 13%, but EBIT growth, which is earnings before interest and taxes, essentially operating income, that growth is greater than 20%. I think it's a good point. I said here, Meta revenue growth 23%, EBIT growth of greater than 100%. Probably see some extreme example with Amazon today, unless things go very, very poorly. If that doesn't happen with Amazon, the stock's probably going to be down quite a bit. But yeah, I think that's a great point. Look at the EBIT growth from these big tech companies. That accounts for what? More than all of the small businesses that are going under. I'm just, it can be sad for those to happen, but yeah, I mean, the big tech companies, we've seen some charts float around. I think we showed in a previous episode of how they're valued at the same level as they were during the Nifty 50. But I think if you look on a trailing basis, they generally, again, Tesla's in there. Kind of, maybe you don't want to include that. They're probably under earning. Forward estimates, I would say, should be much, much higher.
Yeah, I agree. But there's always potential operating leverage at these big tech companies. Like if they really chose to remove bloat, okay, Microsoft, Google, Meta, yeah, they could all have 50% operating margins if they wanted. But it's like I do think it's a conscious decision to choose to raise your margins slowly over time, to not just like collect cash every single quarter and sit on it because you're just asking for regulatory interference and someone to point at you. Like if you're just earning tons and tons of cash and you're not reinvesting and not subsidizing some services to consumers like you see with Google, antitrust comes a lot faster, it seems. So I don't know. I think you're always going to be able to say, well, they could be earning more or they're under earning. Maybe more so right now, but You could always, for Microsoft, Google, Alphabet, or Microsoft, Google, Meta, not so much Apple, Amazon, you're going to be able to say margins are going to expand forever.
Yeah. Give or take. I mean, not forever, but
But it's always a part of the
generally,
thesis. Like right now, for all those companies, it's a part of the thesis that margins just gradually expand.
I mean, just look at the unit economics. Amazon especially. I would say generally Amazon makes those numbers for the broader charts. It's not a chart crime, but it's bad data to have the trailing number for Amazon just because they've just had a period of really heavy investment that's flowing through the income statement over the last 12 months. Yeah. Alphabet's interest. Well, the thing is, yeah, all these companies reinvest into long-term projects, a lot of which probably have low returns on invested capital, especially in the short run. Waymo, good example, but they do have low probabilities of becoming big businesses over time. And it's very tough to underwrite. I would say margin, maybe a little bit of margin expansion should be accounted for all of these, but it's hard to tell. Either way, like I think the earnings power, especially on a per share basis, for all these companies should be able to grow at 10%.
Whatever rate they
right?
choose, to be honest. I think for some of these
give or
businesses,
take.
they can dictate their own earnings growth.
Well, Microsoft did that with, I mean, it's earning, say cash flow, but on
Okay, we're raising
the taxing.
office prices. We're raising the price of Excel. Get with the program.
Yeah,
And it works.
yeah.
Or I mean, they can moderate expenses as they choose. Although Google seems to be having a hard time with that, which is a little frustrating. But why don't we dig into earnings? Where do you want to start?
Yeah, what do you want to do?
Google?
You summarized them, so why don't you go? You go first.
Well, apparently Alphabet is a zero, I guess. It's everyone's selling it. It was down like 10% after earnings. I thought the quarter looked all right. Cloud basically didn't grow quite as quickly as everyone was expecting. And like these businesses are lumpy. And I think someone came on the conference call and said this actually too, that cloud is a lot lumpier than ads. The cloud computing business is a lot lumpier than ads. They're going to have bad quarters, especially when companies are trying to cut costs. So even though Azure had a quarter that was in line with expectations, I think everyone just wants to read into it and say like Google Cloud's going to zero or that Microsoft's winning. And for some reason, they all want to paint like who's winning right now in cloud. Like they're all winning. So
Right.
I don't really understand all the hate around GCP. Operating margins continue to trend in the right direction there. They are still growing 22% year on year. We saw AWS have slowdowns and struggles with optimizations last year. I don't know, like it's going to happen, but it's still growing over time. And then on YouTube, great results, I thought. The
And they're
relevance
understated.
there.
Yeah. I don't know if you're about to hit that, but yeah. It's understated because of the transition to premium that's getting hit.
Yeah. So, I meant both on the advertising side and the premium side. They talked about it. It's all like vague because they just say like what do they call it? Other revenues grew quickly because of YouTube subscriptions, which I kind of hate that because it's like, is that YouTube Premium? Is that YouTube TV? Is that
probably both?
Probably a combination there, but I wish they would just be a little more direct about that. YouTube, to me, is one of the best positioned platforms over the next 5 years, in my opinion, especially moving to CTV, like streaming. There's all these questions for a lot of the players that create their own content. YouTube, you just don't have to worry. Like you just know that their content is their moat, and it's not created by them, it's created by everyone else. So
Yep.
they seem to be in a really good position.
Yeah, I don't know if I'm buying shares today. Stock still, I'd say not super cheap. I wish they would buy back a little more stock. But the nice thing about not having estimates going into a quarter, which I get it's the people's jobs, but for the people where it's not your job, it shouldn't really matter to you. I saw the 22% growth for Google Cloud and was like, okay, that's fine. I don't know what I should have expected. It's just the result is going to be the result. The search results maybe were better than I was expecting, which is nice. We're getting back to business there, I guess.
Meta was growing ad sales too pretty quickly.
Yeah.
I think
advertising should have compared
for everyone except our podcast.
Yeah, exactly. I mean, we'll probably talk about Spotify's too. They're growing quickly, ish. But on a nominal basis, obviously still very small. We should do a comparison though. I think it would be nice is to look at the growth of Google search or maybe Google services as a whole on a nominal basis, like how much revenue they added in a quarter versus Meta. Because Meta's still slightly smaller.
I remember doing it last time, and Meta grew a share. I think Amazon grew a share too, but it wasn't by a lot. It was similar nominally.
Yeah, I don't even know if I'd include Amazon because a lot of it's sponsored listings, and yeah, I guess it can be the same as a lot of Google stuff. But are you going to compare
their largest advertising business?
Yeah, but are you going to include like who's in that category? Are we going to include Walmart's slotting fees there? I don't.
Yeah,
it's hard. It's always hard to define
the ad market.
All right, it's always hard to define that stuff. Let's see.
We got a ton of questions. Yeah. Well,
here's one related to Google. How much could they sell Waymo for today? I don't know if there's a buyer out there.
Yeah, I don't know.
It only fits with them.
Do we have their revenue numbers?
Well, I'll just look at other bets.
Yeah, there's other stuff in there too, right?
Actually, I think they give it away right now, since they're in trial period. They don't sell, or it's at a really steep discount.
Yeah, I don't know.
Which doesn't matter. It's not gonna. I mean, they're still gonna burn a lot of money from that division.
It's I would love for that to just be fully operational, and I think in time, that'll be something that probably succeeds. As far as the other bets go, promising. Yeah. I think that's the only thing in my mind that I like. I can't think of what else is under there. There's the what's it called? Wing, which is the drone delivery service. They just partnered with Walmart. You see this?
Yeah, let's get rid of that thing.
You think?
Does not fit into the business.
No,
maybe it fits with. I think Waymo fits in because of the AI stuff. Google Maps. It ties in Google Cloud, but the drone delivery doesn't seem like it fits. It's kind of like Amazon doing self-driving. Doesn't make much sense to me, but it makes sense for them maybe to do drone delivery. You can't do everything, guys.
It's
or maybe you can, but
it's just, I'm just picturing like, how do you come to that partnership? Like what's that process like? Is it just some guy at that division that's like their sales rep, and he's just like he's just taking some Walmart exec out to dinner and like, all right, hear me out. We deliver your packages via drone. We can only do it. We'll do it with like one city. No one will buy it, but we got to say it on our conference call. It's like, so that people know what's going on in our other bets.
That's no. I mean, yeah, they're saying
because Walmart, like,
that's not how Google operates culturally.
No, probably not. But I don't know.
They're not.
It feels like a pointless partnership, to be honest.
Yes. Yeah. We got a comment here. I was confused on the Waymo stuff. I always get confused on that. He said, I took a Waymo. Guy named Michael says, took a Waymo, was $12 versus Uber 25. Showed up in 3 minutes. Okay, whatever. 12 a.m. in San Francisco. Yeah. So they're essentially giving it away at a big discount right now. Probably makes sense. Again, the revenue number is not going to matter to Alphabet for a long, long time. So I wouldn't even mind if they just gave them away for free. But right now, it's more of a novelty
with Cruise
thing.
out of the picture in San Francisco. You see this? Cruise got their license revoked.
It's interesting that they may have been like they hid some data potentially. We'll see what the full story comes out on that over time. We got another one on Tractor Supply. Had earnings this morning. I will say we're doing a interview on Tractor Supply with a Value Stock Geek who people may or may not know. So I think we'll maybe save that for then. Tyler says, loved the Merger Arb pod. I will say that's the episode you'll see before this on your podcast feed. So go check that one out. Better question. What's the negative net present value of Reality Labs? How much would the market cap increase if Zuck woke up one day and just canceled it? We've talked about that one before, but maybe that can transition. You probably had Meta on here. Why don't you?
What do you think is the market cap contribution of Reality Labs to Meta? My guess is minus 200 billion.
Yeah, give or take. I think that's what we came up with before. And it's getting worse, right? Because the revenue is not going anywhere. And it's am I correct on that? I think I saw that, but I didn't really look at the quarter that deeply.
Super lumpy because it's like hardware based and product release based. But
right, sounds like a great business.
Do you know anyone that still uses like Oculus or Meta Quest like goggles? No. I don't know anyone.
No. Yeah, who
maybe there's certain applications at like the enterprise level for like engineers or something like that. I see them they really advertise that. I see them constantly like, here's how the Meta Quest is being used in organizations.
Oh yeah, they got some.
Why do I care?
Yeah, they got a commercial that probably cost $5 million where everyone's looking like they're all nodding their head and everyone's happy. There's really, really upbeat music playing. Yeah, let's go through the numbers here. Reality Labs revenue 210 million. Reality Labs operating loss this quarter 3.7 billion. So run rate, what are we at? 12 plus 2.8, 14.8, basically $15 billion on run rate operating loss there. So,
and it could grow.
200 billion might be, yeah, it could. 200 billion might be a bit aggressive. Maybe. Because that's a lot of years.
I don't know. I do think
a lot of years.
If they announce tomorrow, we're done with Reality Labs, we're moving over our resources to family of apps, like our engineering resources and all that capital allocation, those investments, you don't think they'd add $200 billion to their market cap? I think it's very possible. What are they at today?
Maybe.
They are at 730 billion. So you would need a 25% increase jump in the stock. I think it's doable.
Yeah, more, but 33%. Yeah.
I don't know. Hard to say. Reality Labs is certainly a negative contribution to the investment today. But
the results look good. Yeah. Probably the best big tech so far. Until Amazon reports today, right? This is going to jinx it. The best big tech report until Amazon reports after the close.
Yeah. How do you think this goes? My guess, and I'm stealing some of these takes, great results. Cloud doing well. Profitability's back. Jassy hops on the call and says something super pessimistic. Boom, we're up.
Yeah, it'd be nice if they did that. Yeah, it'd be nice if they were pessimistic and bought back stock. But if they're not going to buy back stock, I don't care. Just be optimistic if you don't want to keep the stock cheap for,
All right, some other earnings that I thought were interesting. First of all, I read Google's conference call and Alphabet's. Boring. Ruth Ruth's killing me. Some of these answers are the most word salad, mean nothing answers I've ever seen.
Well,
You
she's
have to
out of
like,
here. She's gone soon. So
yeah, you literally, it could have been a yes or no answer. They were just like, do you still plan on increasing revenue more than operating expenses next year? And she gave, let me find it because I want to read this. And it was, you could just say, yeah, we do. Or you'd be like, no, we've changed our guidance. But instead, she said, let me pull this up. I know this makes for really good. She says, so, yeah, he said, you talked about how expenses could grow slower than revenue in 2024. Is that sort of still the high level way to think about it? Ruth's answer, sure. Thanks for that, Brian. So overall, that's sort of a truism, as you know well, looking to grow revenues at a faster rate than expenses as we're focused on delivering sustainable financial value. And so that really takes us to the work streams, which I tried to tick through. Again, those remain the driver. They're the real priority. Those are the efforts that are going to enable us to expense growth. And it's moderated as possible while supporting the. I don't understand. What does that mean?
yeah, just say we're gonna be like not get crazy on hiring too many people again.
But
It's
my concern
pretty simple.
is that was her way of saying like, well, we were planning on that, but AI, those engineers cost a lot, so we're gonna have to
Yeah.
actually change that.
Yeah. Well, yeah. Not gonna matter. At least they're buying back
You
stock.
got to speak CFO in order to understand it, though.
Yeah. It is a annoyingly nothing conference call. They just throw out a lot of tidbits on data that's irrelevant. And maybe it's fine because the moat's so strong, but
Okay, Mexican airports. You hear about this? You see this? Follow it, track it.
a little bit. I didn't check the details.
Okay, so like a month ago, Mexican government released some statement or whatever the aviation sector of the Mexican government released a statement that they are basically reevaluating the tariffs or the contracts that they have with private airports. And they reached an agreement, I want to say a week ago now, all the private airport operators with the government that taxes are going to be going up from 5% of gross revenue to 9% of gross revenue. Start date isn't determined yet. What do you think? How does this, if you were thinking about investing in any of the Mexican airports, how does this change anything?
Well, I would say if this changes anything, you didn't understand the risks going into these. This is one of the risks, and it can happen. The government in Mexico, say most people, well, should I call them incompetent? Or maybe they're just a little wacky or unpredictable. Maybe unpredictable is the best way to put it. The Mexican government, kind of hard to predict what they're going to do. So, and when you're beholden to them, this is how you do things. You know what can happen from time to time. Is it an overreaction? Maybe. The one thing I do like about these stocks, which can mitigate some of this risk, especially if you buy at the right price. I think this is another example when we're looking at companies outside the US, we want a pretty big discount, like really cheap multiple. But other point is they pay a pretty hefty dividend. You get some of that cash back, you know, if things go sour, right?
Yeah, the yield's not as great as I would have thought, but yeah.
We're at about 6% for OMAB right now. That's the ticker.
Yeah, Pacifico Airports, I think it's like 3.5.
Let me try to find total returns for these things. But you go ahead.
Yeah, it seems like you've got a company that is earning 70% EBITDA margins, and they're at the whim of the Mexican government. It just felt like a recipe for the government to step in and take something, because they knew they could.
Maybe.
That was,
yeah.
I don't know. There we go. It's a point that kind of provides a little bit of a little bit of confirmation for my point earlier. When you over earn ridiculously, everyone comes for you and comes for those earnings, especially when you're basically not a government run business, but we're enabled by the government.
Yeah. That's why you gotta, yeah. And
that's why big tech pays for ridiculous bets.
Maybe. I don't know if that's why they do it, but I think what can maybe counter that, or the ones that are the exception to the rule, are platforms that, or networks that require no people to run, or there's no labor associated.
Do you even
could
think
be a service
about
as well? Visa,
I imagine you're talking
MasterCard,
about, yeah,
Moody's,
with
yeah,
with like
Evolution
Visa and
Gaming.
MasterCard, it's not like people don't want to disrupt them or don't want to step in. Like we've seen it before. Everyone's tried. It's just
There's a new bill.
can't.
Yeah.
Governments have tried. The Indian government, and yeah, there is a new bill out right against them.
For the debit cards, yeah.
So rule number 1, never show more than 50% margins.
I don't know if that's how I would operate, but it's definitely a risk. If you have high margins, probably have a competitive advantage, which means you could be described as anti-competitive. That's kind of the definition of a competitive advantage. That's what Buffett, doesn't he doesn't say it that way though. So yeah, it's interesting. I will say, let's look at the total return. I looked it up for OMAB, Grupo Aeroporto, or Aeroportario. Yeah. Okay. Ticker is OMAB for the English speakers, and
do you know which
people who want to look at the
are?
ticker. I do not, but I know this is one of the Mexican ones. Went public, looks like right around the GFC. Total return since that time, after this drop, 550%, beating the S&P 500, 313% over that same time period. So not bad at all.
I wanted to talk about this Match Group paper that I read. You want to move to that?
Yeah. I want to know why you always find these things a month after they get published.
Because
you're like behind the ball on all these.
I know. Whatever. Doesn't matter. I hit save. I like them. And then I don't read them in the moment. And I come back.
You get overloaded, then you have your list. And
and then I go through this list. And in the moment, I don't know which ones I'm going to be like, wow, I'm really glad I read that paper. So I ended up reading a bunch of stuff that I probably don't need to read. But anyway, so it was a really good piece by George Hagia on Twitter. He actually recently went on a Business Breakdowns episode, which is a bummer because I was going to reach out to him and see if he wanted to come to the
I
same
reached
thing.
out. That's what I reached out a month ago, but he said, I'm recording Business Breakdowns. Like, all right, well, you graduated behind us. They got you. So
anyway,
listen to that though. That's a good, if you're interested, people, listen to that one.
It's a really good piece. I had there was one point that he made that I had kind of thought about, but I didn't really have a way of like articulating what I was thinking, which is the saturation at Tinder. Like, why is it happening? And it felt like we even did a whole episode around like what's going wrong at Tinder, because the growth is kind of plateauing, especially on a usage basis based on Sensor Tower data. And we kind of came up with a number of reasons, but I think he articulates it really well, which is that at some point there are diminishing returns of Tinder. Got big because it was this network effect business, right? If you're a guy in a town and you've got a 20-mile radius and there's 100 girls, if you add another 100 girls, the platform gets that much better, right?
Especially on a college campus, easily goes viral.
Right. But today, especially in big cities, there are so many people and there's not that much way to filter, because Tinder, the whole shtick is that you can get set up really fast. You don't have to put that much stuff. With Hinge, it takes like 15 minutes, even 30 minutes to set up a profile, right? You got to add bios. You got to put
30.
like
You
You
want
think?
a lot of, but a lot of,
Some people take a
wow.
time. No, I think on average it was like 15 to 20 minutes. I can't remember where I saw that, but the you're putting in like whether or not you drink or smoke, what's your religion. You don't have to show all these things, where you live. You have to answer a bunch of prompts. With Tinder, you just post 4 or 5 pictures and you're good to go. So because it's so easy to get up and running, there's not that much filter capabilities, which means you're filtering through potentially, like, if you've got 50,000 people in your city that are potential mates or potential significant others, the 60,000, the next 10,000 they add, it's really not that valuable. And you got to filter through so much, frankly, crap to find anything relevant. And it just really erodes the experience. So they call these, and I can't remember who came up with the term. I think it was A16Z did this report. Instead of a network effect, they're called network contaminants, where it erodes the experience. And we saw this especially with a lot of the fake accounts and stuff like that. And he just did a really good job of articulating why that's been an issue and how it's kind of, I think, ultimately led to some saturation. So I guess my question posed to you is, what do you do here if you're match group? How do you fix that problem at Tinder specifically? I know Hinge is like on basically really well counter position to that, where there's so much ways to filter. How do you fix the problem at Tinder there?
I think there's two ways. One, they're already doing, and I'm just copying what they're saying they're going to do for the other one. One is use these AI tools to eliminate more of the fraudulent accounts, the fake accounts, which they've been doing. And they gave out some data on it, but it's clearly working. It's much better than it used to be. I think that problem is not solved, but it's in a much better spot than it has been. And then second, they're just going to have to, they kind of rested on their laurels, right? For 5 years with Tinder, the product didn't change. And now that it's so big, I think creating filter tools, I don't know if they should make it a paid tool, because you probably want everyone to have access to these things, at least the most important ones. But I'd say allowing, the thing is, you want to make it easy for people to onboard, but I don't think that's the biggest issue now. You should probably force people to give at least 5 or 6 characteristics of themselves. Yeah, some people are going to lie. That's how it goes. But
That's the other.
You do that and you'll allow people to filter a bit more, and hopefully that could lead to better results. So
Yeah, that's the other thing with
seems
Tinder.
seems solvable, but go ahead.
That's part of the difference between Tinder and Hinge is with Tinder, you have to match. Basically, you can't see your likes. With Hinge, you can see who's liked your profile. So when you have to match and you have 60,000 people to filter through, you got to be on there longer to find a lot of matches. So it gets harder in bigger cities. Whereas Hinge, you're kind of right off to the races once you're kind of on there, and you can filter by a whole bunch of things, whether or not people smoke or drink. You can filter by height. Sorry for all the short kings out there. But there's ways to really zone in on your focus or zone in on your search that Tinder kind of doesn't have. And I'm concerned that you can't walk that back. I think there becomes a problem in terms of new user onboarding if you start to have all these, like, you gotta say 5 things or whatever.
Yeah, I'm not sure.
Maybe it helps. Maybe that's where the AI improvements, where the AI, like, helping with prompts, picking photos, stuff like that, can speed up that process.
Yeah, I think you might be overthinking it.
Could be. Certainly could be.
There's so many ways to go about this, and for this situation, they have all the data, they know what's actually going on. Kind of worries me that they might be seeing some things that they're hiding from the Tinder quality or region perspective. That's the big worry for me, is how bad are the numbers in certain regions. But I'm going to let them make the choice here, because they probably know what's going to work best. There were some things that seemed obvious, like the weekly subscriptions. Just intuitively, we were like, yeah, we'd use these. But yeah. All right, let's go. Yeah, 20 minutes.
I was
Let's
also
hit some
gonna
other
say,
stuff.
I connected with Bernard Kim on LinkedIn, asked him if he wanted to come on the podcast, and he ghosted
No
me.
response. Yeah, well, all right. It's over.
So,
I
yeah.
doubt that he's actually on there. If he's actually if he's responding to you on there, that's a
red flag.
yeah. If
As an
you're actually
investor, like,
if you're a CEO and you're actually on LinkedIn and don't have, it's not just there with the the IR team or something is managing it for you. I don't know. Like, seems
all right, what
seems
else
like
you
a waste
got?
of time. Let's hit Spotify earnings. Seem pretty solid all around. People were surprised, but I don't know why they would be. Bar was pretty low from a profitability standpoint, but I'm curious your thoughts because I thought it was really good.
Yeah, I thought it was a good quarter across the board. I mean, they're profitable. They're actually profitable. Is that the first quarter ever?
I don't think so, but one of the few.
It yeah, I've kind of made this mistake before where, and it seems like they're focusing more on the operating expenses. I think operating expenses came down, if I'm not mistaken,
Correct.
actually.
Yeah.
But I worry about taking any sort of long-term, like extracting the current quarter or extrapolating out the current quarter's gross margins and just saying like, oh, we're moving up in gross margins, because we've done that in the past. And even though they did attribute some of it to better podcast profitability and marketplace activity, there's so much lumpiness with their gross margins that I worry that, I mean, the premium side is good, but the advertising side, it's going to take continued operating expense discipline. It's not just like one quarter is not going to do it. Like, this isn't. I just worry about extrapolating out these current results.
Yeah, that's fair. But also, if
But it was
they
good.
give
I
out
mean,
that anecdote on podcast revenue growing quickly, they never give the exact number, but they always say something like robust double digits, which could be
it could
20,
be
could be
literally
60.
anything.
Yeah, it could be 20, could be 80. I think those are some key numbers because you're going to get the operating leverage on the gross margin side of things, just because of the way they do their accounting. If the podcast revenue just needs to get higher, and if that happens, we should see consolidated gross margins inch closer to 30% because the premium gross margins already fine.
I do think we're seeing also, just like anecdotally, better, like some serious improvement on the advertising side, where Spotify Audience Network, at least for me, it's filling more frequently when I listen to shows where it's plugged in. I think on our shows, we're seeing better impressions too. So, maybe you're hearing one right after this or right before this, something like that. That's them hopefully improving. And maybe it's just better advertising demand. Like we've seen that with Meta. We saw that with Google. So that would be a huge boost. I think that'd be helpful. But we've long said it's not a gross margin issue, it's an operating margin issue with these guys. And they seem to be taking that to heart. Not like what we're saying, but they're starting to kind of find religion with moderating operating expenses, which is good. I worry that they're kind of like one of those companies that just skate wherever, like they talk about what everyone else is talking about, that they just kind of invest randomly. And there hasn't been that much strategy. Like we saw that really with the podcast efforts. I didn't appreciate it at the time, but we've seen articles come out now where some of the people that have been laid off there were like, they said management was like, we don't care what you spend, just go out and try to get listeners because, capital's cheap right now.
Podcast numbers. Yeah. When the live audio stuff was out, luckily they didn't waste too much money, but
Live audio, AI.
I'd say investors are lucky that AI is actually a huge, like there's so many promising things for them with that, whether it's improving the playlists, improving the search results, doing the audio advertisements, reducing friction there. some of the stuff they have for cross language, for a lot of things. I mean, there's just an endless amount of opportunities for them to invest in these products and improve both monetization and the user experience. So I'm glad that AI is the the theme of the day, because Spotify can benefit so much from that.
No, but just feels like every time something new comes out, this happened with live audio. I was like, well, they're kind of just doing what everyone else is doing, or they're like writing whatever the hype cycle is. And I'm like, oh, it might work out for them though. Like same with AI. I'm like, AI DJ. Oh, that makes a lot of sense. I've never used it. I've been a Spotify user.
I use it like every day. It's
Really?
great. I think they said it's even, I mean, yes, they are hype cycle writers, but this AI stuff they've executed pretty damn well, and it's, I think, showing tons of results. And the advertising stuff is great because unlike a Google ad, Amazon ad, or Facebook ad, it's difficult. I guess there's a little bit of friction to produce an audio ad, and if someone can have the ability to do that mechanically for your company, I think that reduces a lot of friction and helps smaller companies join, because it can work if you're a large business going to a agency, they record it for you, or whoever it would be. But it's kind of hard to convince someone to say, hey, record this for us, add it on here. But if you can give them the script, give them your voice or something, or they do the voice for you, I think that's quite promising.
Yeah. We'll see. I still think there's low hanging fruit that they could go after for advertising that would help all sides of the marketplace. Like,
what do you think?
Letting podcasts do banner ads,
promotions. Okay. Yeah.
I mean, that seems like a pretty simple one. Podcast to podcast advertising on Span. I don't know if they've rolled that out yet, but for the longest time they weren't allowing it. I'm not sure what the point of that is. I don't know. It just feels they go after and they invest a lot of resources in very audacious things when there's sometimes low hanging fruit right in front of them that they should be focused on.
Mm-hmm. Mm-hmm. All right.
I think they should give better data to the podcasters as well. They've made tons of acquisitions over the years that they just haven't blended together.
That's true. They're giving a little bit now, but yeah, I agree with that. They spent a lot of money on that. I think it should be a little bit better. I will also say, temper expectations on those MAU numbers. Almost so much of them are coming from very low income countries, which
India
isn't
a lot of them.
Like, it's not
India.
It's not a negative, but these are not going to be as valuable because the premium subscriptions there are much less. Okay, I wanted to talk about this. It's a bit weird and comes back. We've talked about this before, but it kind of had been a moot issue for a while. But I guess with interest rates not coming down, the real estate market still in a very strange spot. Residential's obviously been we've talked about those dynamics before, but the commercial side of things is struggling quite a bit. There is the Blackstone Real Estate Income Trust, BREIT or BREIT, that we've talked about. I'm not going to pretend to be an expert on the mechanics of this thing. I would reference a lot of other people that if anyone's interested on, you'll be able to find those out there that go through what is happening. But essentially, it is a fund and invest in these real estate assets. Most likely, these real estate assets are worth a lot less than they are being marked today. However, Blackstone is still receiving fees on these assets. And
not true. They're worth whatever people will pay for them. And if they don't have anyone paying for them right now, they don't have to remark
They're
them.
worth whatever they decide to mark them at. The
mark to myth, isn't that what they call it?
Yeah, that's a good one. Yeah. There's a lot of sayings for people complaining about this. But there is, and I want to confirm what the exact NAV is. Yeah. Okay, here it is. So there's a company, or maybe it's an LP, that is offering investors in BREIT the ability to pay them $9.27 per Class S share. So $9.27 per share or per unit, but That is a 38% discount to BREIT's estimated net asset value per share of $14.88. And I may just be describing it differently, but again, it's from the paper they are soliciting to people. It's a 38% discount. And here's the thing. It's because BREIT is gating redemptions. So if someone wants to redeem, they might not be able to for a long time. And Blackstone is still earning fees on these things at these inflated valuations. I think, look, you can't, the F word, fraud, can't accuse someone of that without them being proven. Even someone like SPF, right? We got to wait for the legal system to run its course. But I think this is extremely shady behavior. Maybe someone can explain it to me differently. Blackstone.
Let's put the brakes on that, because anyone can do this. We can go out and we can offer up a paper that says we'll pay you $1 for your $14 shares if you want. It doesn't mean anything. Unless there is a lot of people take up this offer. If a lot of people take up this offer and things aren't remarked, then yeah, this is a huge issue and it's very fraudulent.
Well, I think I guess they signed the contract. It's just, I think scummy maybe is the right word.
To not let people pull money out.
Unethical, the way they describe. Yeah. I mean, this thing is huge. It has it earns a lot of fees. Again, no expert on this. So look, I could be corrected wrong. Blackstone could be fine here. But from the smart people I follow that follow REITs, follow this sort of stuff, follow market structure, follow all these things, they're like, hey, like this is a really big issue. And TBD what's going to happen, but we'll see. It'll be fascinating to follow because it's huge. I think I had like 60 billion in assets at one point.
REIT, yeah, I mean, it's the biggest real estate. Isn't it like the biggest real estate partnership?
Maybe private REIT. Yeah, I don't know. In some subsector, either way, it's big.
I mean, I buy that it's big, but I think we got to see how many people are willing to take up this offer. Because if there's a lot of people willing to take up this offer, then everyone's going to know that Blackstone has a problem. I think a lot of people already have a good sense of it, but we'll see for sure. The thing that I find interesting, and probably maybe the thing I've learned the most in running our fund, is that a lot of fund managers out there, even though they've done better than we've done, pay themselves first. They're focused solely on earning their fees. And there isn't, and maybe it's because it's Blackstone, it's huge. You don't really have a personal connection to the investors, but they don't really take care of their investors. Like every fund has that, pretty much every fund has like that waiting period or whatever, the lockup agreement. And if you try to break the lockup agreement, maybe you have to pay, or people can stop certain redemptions. Managers can just waive that. I mean, they can waive that if they want.
Yeah.
And let people.
But here's the thing.
Now part of the problem is that they're in a bunch of illiquid assets. It's really hard to sell. It's not like it's public equities, but to me, if people are taking this up and they're still getting redemptions, it screams to me that they're not really taking care of their investors. The BREIT in this.
Well, there was a guy that follows this named Phil Bach. I believe that's how you say his last name. Good follow on the old X/Twitter. He's the one that shared this. I gave it a retweet if anyone wants to see that. Basically said, Mackenzie Capital announces a tender offer. That's what I should have said. Tender offer to BREIT investors at a $9.27 per share. The current NAV is $14.81. I guess that's the updated one. A 37% discount. And Porter Collins, as people may remember, this is the real person played by one of the people in The Big Short, says, he knows a thing or two about real estate. He says Something I really don't get this far. He says, give me a two-way. There's a 0% chance $14.81 is the correct NAV. And then someone responded, probably. Wait, maybe that's a reference to Steve Eisman. He says someone responded, the correct NAV is 0. Let's hold our horses there, but
yeah. Okay, a lot of these are just like major real estate assets. I don't think they're worth 0, but
depends again. It depends how much leverage they used.
True. I think maybe it might be a little premature to be dancing on Blackstone's grave here, because, like I said, anyone can throw a tender out there. It depends how subscribed it is, or how many people accept the tender.
Yeah, and Blackstone's been a damn good business for a long time. Right.
Yeah. Plus they can,
but
for the time being, they can just raise new capital to fill the hole.
Here is something I want to leave with people today. We got about 2 minutes left. We didn't get to the Brooklyn Investors blog post, which I thought was really good. But yeah, okay, I want to get to this Phil Fisher quote as we close things out. I think it relates potentially to this, but I think it's also good for people to think about. Here's the quote from Phil Fisher, one of the best investors ever. History has shown that in every age and in every field of human knowledge, many of the views which almost everyone accepted as true and never bothered to think about further were in time proven completely wrong. So I think the key points there, everyone accepts something as true, but no one is actually thinking about it.
So real estate's going to go down. So home prices will fall.
Home prices will fall. No, people are thinking about that a lot, but I would say maybe the private equity model, but there's not very many naysayers for that type of stuff. And I'd say maybe it's not bad. I'd say it's not the bad end of the world to have some skeptics like these people complaining about BREIT, right? It's good to have people balancing that out.
Yeah, for sure. Yeah, I agree. All right, we got a minute left. Any comments are in here? Someone asked about Autodesk.
Yeah.
Any updated thoughts there?
Same old. Great business. One of the best businesses in the world. I wish an activist would come in.
We should I'm not a fan. Really nudge. What's his name?
Anagnost. Yeah, tough last name.
No, sure. not Andrew. The
Elliott Management.
Elliott. Who runs that again?
Paul Singer.
Paul. We need Paul, and we need his protege. Can't remember his name, but the guy that went into Salesforce and basically just showed Benioff what he wants him to do. We need him to just step into Autodesk. It would be good for their portfolio. It would be good too, because it's sizable and it could actually have an impact for them.
Yeah. They're going to be like, well, let's show some slides on the rule of 40. Now we're going to, have you heard of the rule of 40? And then he's going to be like, he's just going to cut him off right away. And he's like, here's what you're going to do.
Let me show you our next CEO.
You see this 50 comms staff you got here? We're going to let most of them go. They're good people. And then we're going to lever up and buy back some stock. All right. Let's close things out. Let's hit the disclosure. Thank you everyone for tuning in. Thank you for the comments. You can listen to these everywhere you get your podcast, YouTube, Spotify, Apple on Sunday mornings, or you can watch live as some of the people are doing now. But either way, doesn't matter to us. As a disclosure, we are not financial advisors. Anything we say on the show is not formal advice or recommendation. We are general partners at Arch Capital, and clients may hold securities discussed in this podcast. Thank you, everyone, for tuning in. I'll see you next time. Or we'll see you next time, I should say.